Welcome to EcoFun's video on the influence of monetary and fiscal policy on aggregate demand. In this video, we examine how the government's policy tools influence the position of the aggregate demand curve. John Maynard Keynes proposed a theory of liquidity preference in his book The General Theory of Employment, Interest, and Money. According to Keynes, the interest rate adjusts to balance the supply and demand for money. The content of this concept is expressed as follows. People have two needs for cash. Transactions demand. This quantity of cash demanded is proportional to income. More income means more consumption. Speculative demand. This second quantity of cash demanded is inversely proportional to the interest rate. The more attractive the interest rate, the less people hold cash. Less attractive interest rates means people tend to hold more cash. In other words, the interest rate is the price that people sacrifice the liquidity preference of cash, which determines the tendency to hold money. Now let us take a deep dive into the theory itself and the influence of monetary policy on aggregate demand. Money supply. In the US, the money supply in the economy is controlled by the Federal Reserve, also known as the Fed. The Fed can alter the supply of money using open market operations, changes in the discount rate, and changes in reserve requirements. Because the Fed can control the size of the money supply directly, the quantity of money supply does not depend on any other economic variables, including interest rate. Thus, the supply of money is represented by a vertical supply curve. Money demand. Money demand reflects how much wealth people want to hold in liquid form. Assume household wealth includes only two assets. Money is highly liquid but pays no interest. Bonds pays interest but not as liquid. Monetary policy and aggregate demand. Monetary policy impacts the money supply in an economy, which influences interest rates and the inflation rate. It also impacts business expansion, net exports, employment, the cost of debt, and relative cost of consumption versus saving, all of which directly or indirectly impact aggregate demand. Expansionary monetary policy. Expansionary monetary policy involves the central bank either buying treasury notes, decreasing interest rates on loans to banks, or reducing the reserve requirement. All of these actions increase the money supply and lead to low interest rates. This creates incentives for banks to loan and businesses to borrow. Debt-funded business expansion can positively affect consumer spending and investment through employment, thereby increasing aggregate demand. Expansionary monetary policy also typically makes consumption more attractive relative to savings. Contractionary monetary policy is enacted to halt exceptionally high inflation rates or normalize the effects of expansionary policy. Tightening the money supply discourages business expansion and consumer spending, as well as negatively impacts exporters, which can reduce aggregate demand. As for fiscal policy and aggregate demand, fiscal policy is the setting of the level of government spending and taxation by government policymakers. Expansionary fiscal policy causes an increase in government spending and/or a decrease in taxes, which shifts AD right. Contractionary fiscal policy causes a decrease in government spending and/or an increase in taxes, which shifts AD left. To further elaborate, expansionary fiscal policy, usually enacted in response to recessions or employment shock, increases government spending in areas such as infrastructure, education, and unemployment benefits. The theory is that extended unemployment benefits helps to stabilize the consumption and investment of individuals who become unemployed during a recession. Contractionary fiscal policy can be used to reduce government spending and sovereign debt. Aside from the level of government purchases, the level of taxation is another element of fiscal policy. When the government lowers personal income taxes, for example, households' take-home pay rises. Some of the extra money will be saved by households, but it will also be spent on consumer goods. The tax cut changes the aggregate demand curve to the right because it promotes consumer spending. A tax increase, likewise, reduces consumer spending and causes the aggregate demand curve to shift to the left. The multiplier and crowding effects influence the extent of the shift in aggregate demand caused by a tax reform. The multiplier effect is when government lowers taxes and boosts consumer spending. Revenues and profit rise, boosting consumer spending even more. Simultaneously, more income leads to increased money demand, which causes interest rate to rise. Borrowing becomes more expensive when interest rate rises, reducing investment spending, which is the crowding out effect. Furthermore, household perception is also a factor, as a permanent tax cut can have a large impact on aggregate demand, while a temporary tax cut can have a small impact. Finally, let's talk about fiscal policy and aggregate supply. Fiscal policy might affect aggregate supply because people respond to incentives. A cut in the tax rate gives workers incentives to work more, so it might increase the quantity of goods and services supplied and shift AS to the right. Government spending might also affect aggregate supply. For example, government increases spending on roads. Better roads may increase business productivity, which increases the quantity of goods and services supplied. Shift AS to the right. Although this effect is probably more relevant in the long run, as it takes time to build the new roads and put them to use. That is all for this video. Thanks for watching.